I'm Chance with We Sell Broken Bow. Appreciate you tuning in. Hey y'all, appreciate y'all tuning in. I'm Chance. This is We Sell Broken Bow, and we're gonna get right into it. We've been hearing a lot of chatter recently online and folks in our real estate industry all over the country talking about possible changes in the mortgage and financing world of real estate. And so we're going to share with you here some of the stuff we've been hearing. And just within this past week, CNN has come out with an article that the Trump administration is actively evaluating portable mortgages. Here's what you would need to know. Trump administration has another idea to make housing more affordable. Let homeowners take their mortgage rate with them when they move. On Wednesday, Federal Housing Finance Agency Director Bill Pulte said the administration is actively evaluating so-called portable mortgages. On Wednesday, Federal Housing Finance Agency Director Bill Pulte said the administration is actively evaluating so-called portable mortgages. The proposal aims to address the housing market's lack of supply. The administration stepped up efforts to address housing affordability this past week. Pulte, who oversees Fannie Mae and Freddie Mac, the two government-backed entities that guarantee more than half of U.S. mortgages, said officials are also weighing options on how to make mortgages assumable and whether to introduce the new 50-year mortgage option. Just over half of homeowners with a mortgage have a rate below 4%. According to a Redfin analysis of FHFA data. However, average mortgage rates have remained stubbornly stuck between 6% and 7% for the last few years. Homeowners who locked in ultra-low mortgage rates have been less willing to move and potentially pay hundreds more in interest each month on new mortgages at current rates. So that's definitely something that I can affirm and agree with. Particularly this market here in Broken Bow and Hochatown is not a market that folks are moving to. So this isn't really a problem area in this market. In fact, over the past few years, we've really had an abundance and perhaps a surplus of inventory of cabins on the market rather than where most residential and popular residential towns and areas like North Dallas, the major metroplex areas, have really over the past few years had more lack of inventory. So really an opposite market, opposite dynamic up here in Broken Bow. And so we do see that changing. We do see inventory levels normalizing. We're looking at what we call months supply. More on that in another video, another episode here before long. So anyways, back to this article. Allowing people to keep up their lower mortgage rates could encourage them to move and free up supply. But there are questions about how that would work and whether it might wind up actually raising mortgage rates overall, said Susan Watcher, a professor of real estate at the Horton School of University of Pennsylvania. When asked by CNN, the FHFA did not provide further details about its plans for portable mortgages. In a statement, however, a spokesperson said the agency was studying a wide variety of options to lower housing costs. How do portable mortgages work? And why I would say something like that is, come on, if we're going to work on these loan programs to free up supply, increase the ability for people to buy, this is just going to decrease friction in the market. When you decrease friction in the market, you're going to increase the speed at which transactions are able to occur, increase the number of people that are live. And again, this is all in a vacuum or theory, right? Because so many other details on other ends of other programs that could be changing, doors closing, who knows, this, that, and the other. But for the most part, you decrease friction, you increase speed in the market, and that's not going to decrease prices and help with affordability. How do portable mortgages work? A portable mortgage allows a borrower to transfer their existing mortgage and mortgage rate to a new property when they move, instead of taking out a brand new loan. For instance, imagine a homeowner selling their house for $400,000 with half of that paid off on a 3% mortgage. With a portable mortgage, they could sell their home and transfer the $200,000 left on the loan to the new house, keeping the 3% rate. Things get trickier if the new home is more expensive. If it costs $450,000, for example, the buyer would need to cover the extra $50,000 either in cash or through a second smaller loan, likely issued at a current higher interest rate. So this is all theory, this is all speculation, but this is just stuff that they're talking about and possibilities of changes to look out to in the future. The hope is that if homeowners could move without losing their low rates, more homes would go up for sale, giving buyers who've been locked out a better shot. Watcher said, but the effects on supply would likely be limited, and it might take Congress passing a law to iron out legal wrinkles. Yeah. So many details on that we're not even going to get into, so much conjecture. Might this backfire? Portable mortgages could disrupt the engine powering the U.S. housing market, called mortgage-backed securities. Those are essentially bundles of mortgages that banks or lenders sell to investors, which gives the banks the cash they need to issue new loans and keep the mortgage market flowing. If homeowners can take their loans with them when they move, fewer loans will be paid off early, which means more risk for investors who might demand higher interest rates to compensate, Watcher said. Additionally, mortgage agreements are clear contracts tied to a specific property with the home's address listed as collateral. Transferring that loan to a new house would mean effectively rewriting the contract. So again, just details, and they're putting it in our layman's terms here, details that they're flushing out, this, that, and the other, contemplating. It's too early to tell what's going to happen, but it's going to be a logistical nightmare, said Justin Demola, the president of Lenders One, a national alliance of mortgage bankers. All mortgages have a property address, a legal description. How do you get around that as you're taking the mortgage to the next property? Oh, that's so simple. So simple. Come on. I mean, for so long now, there's more, I would say, respectfully sophisticated and more seasoned investors are aware of multi-property portfolio loans and things like that for these investors that have multiple properties and stuff like that. So it's really just a matter of that bank that's issuing the loan going to reappraise, revalidate the credentials of the next property, and then essentially swap collateral. So let's see here, back to the article. What else is the administration considering? The Trump administration is also looking into 50-year mortgage, which is a terrible idea. Terrible idea. But the proposal has drawn backlash. Yep. From some housing experts. They argue that the monthly savings would be minimal compared to the significantly higher interest costs over the loan's life versus a standard 30-year mortgage. Absolutely. The administration also has brought up potentially allowing more assumable loans, meaning home buyers can take over a seller's existing mortgage and mortgage rate. Great idea. Definitely a good idea. Most government-backed loans, such as those from the Federal Housing Administration, are already assumable. In fact, there are companies that help buyers find homes with assumable mortgages. However, Demola, whoever this Demola guy is, never heard of him in my life, said he doesn't see many first-time home buyers assuming other people's mortgages, since doing so typically requires a large cash payment or second mortgage to buy out the existing loan. Loans have been assumable forever. You don't really see many being assumed right now, he said. So yeah, my experience has been the nature of the next buyer coming in to assume the current owner or seller's loan has for quite a while been a little complex. Most agents really don't want to deal with it. Most buyers and sellers, just no one kind of wants to deal with it. So many questions, and I think concern for fraud, concern for just complication. Folks kind of want to make the transaction as easy as possible and get on with their life and not have to be all that sort of stuff. So that's the end of the article, y'all. This is just one of a handful of articles that you could surely find online that are going to share with you a little bit about what's going on in the mortgage and finance world. So we're rolling out these videos as consistently as we can to share with folks what's going on up here in Broken Bow, give folks a better idea of the landscape, the lay of the land with the Broken Bow and Hochatown vacation cabin world and the short-term rental market. I'm a realtor, been a realtor for 10 years now, 5 years here in southeastern Oklahoma, specializing exclusively in these Broken Bow and Hochatown cabins. The mortgage world is certainly heating up with some pretty big changes and pretty big ideas. We're hearing discussions about a few different types of mortgage products and loans in the future. Nothing for sure yet, nothing that's really changed just yet. But what we're hearing discussions of are portable mortgages, assumable loans more broadly than we currently have them right now, and even possibilities of them extending loan terms to as far out as 50 years, which personally I think is a terrible idea for the most part, right? I think we could all come up with exceptions or ideas and scenarios where, okay, maybe a 50-year made sense. The reality is it's going to not really reduce the monthly payment substantially. Sure, it'll free up, allow some buyers to maybe be able to now barely afford that really couldn't otherwise. But the reality is, again, in my personal opinion, if you really can't afford to purchase, you can't afford to purchase, and go find a place to rent, find another market to move to or be in. It sounds possibly judgmental or critical, tough, but extending mortgage terms so much further, not just to mention the increase and the effect that has on the amortization of the interest paid is just absurd. The interest paid on a 30-year term right now is just absolutely freaking asinine. On a 30-year term, even at interest rates as low as 5, 6, 7%. So you're going to extend that to 50 years. I mean, that may about double the interest paid. For example, if I go to a mortgage calculator right now, my favorite mortgage calculators, often calculator.net. Calculator.net, mortgage calculator, home price. Let's say, here in Broken Bow, the average cabin price is probably near $600,000. 20% down payment, loan term 30 years, interest rate 6 point something percent, property taxes 1%, property insurance annually on this 600,000, I would estimate it a few thousand a year, HOA, et cetera, et cetera. So calculate just rough numbers on a $600,000 property. If you put 20% down, finance over 30 years at 6% interest, give or take, over the life of the loan, total interest paid is actually $600,596. So if we extend this to 50 years, goes from 596 interest to 1.1 million or more in interest, nearly doubles the interest. So for whatever practical purposes or reasons or whatever, as early as you can, you should probably vote against the 50-year mortgage. You should probably not be a proponent or a fan of the 50-year mortgage. Terrible freaking idea. Terrible idea. Although portable mortgages, hopefully those come to fruition. Assumable mortgages and loans where the prior owner or seller of a property could allow transfer of that rate to the next buyer. That could be attractive. That's probably a good idea 50-year mortgages, thumbs down on that one. Terrible idea. So before we go any further, let me be clear, none of this is official yet. These are just conversations, not confirmed programs, not approved products. But here's the important part. Changes are definitely on the table and likely to come into fruition over the next year or so. And the investors who stay aware of these shifts earlier are usually the ones who are in positions themselves to stay ahead of the market. In a fast-paced and fast-growing market like Broken Bow and Hochatown, you don't want to be the person who hears of this stuff last. So let's break it down in simple terms again, just to reiterate what a portable mortgage might be, what an assumable mortgage is, and what they're discussing with these 50-year mortgages. Portable mortgages. This idea would let you take your current mortgage, including your interest rate, and move it to a new home. Right now, you can't do that. If you do move, for example, you typically get a brand new loan at today's or that day's interest rates. Assumable mortgages. This is when a buyer takes over the seller's existing mortgage, including the lower interest rate. These exist mostly in government-backed loans currently, such as VA or FHA loans, but there's talks about expanding them to more conventional loan products. 50-year mortgages, this would stretch your payments over 50 years instead of currently, more commonly, 25 to 30-year loan terms. That could lower your monthly payment, although like I just mentioned, I think it's a terrible idea when you look at what the increase in interest actually is over that duration. About nearly doubles the interest. Definitely vote that off the table if you can. And if and when they do bring it, I mean, the reality is, I think we're becoming more and more aware of how you've just really got to be wise about your own financials and not assume that because the government came out with this, and this, they're looking out for our best interest. So that's all I'll say there. What does this really mean ultimately for Broken Bow and Hochatown's market? Our market is really different from most. People aren't typically buying here to move here as their main home. They're buying these as second homes, investment cabins, and short-term rental properties. So here's the simple truth. Portable mortgages probably won't affect our market here very much when and if they come to fruition. I think here in Broken Bow and Hochatown, we could probably benefit more from assumable mortgages and portable mortgages. Probably not so much the 50-year term. I could imagine that there's bound to be some folks that are crunching the numbers now. $200 less payment now all of a sudden. More cash flow on the table makes sense to buy here. Ups the cap rate by 0.03%. The reality is, if here at this time the difference between a 30-year and a 50-year all of a sudden makes sense for you to purchase up here with a 50-year than a 30-year, I would probably say you shouldn't be buying up here in Broken Bow. So that's just with respect. That's with love and sincerity based on what I'm seeing in the landscape here in Broken Bow and Hochatown right now.